2 years ago, people were getting mortgage rates that were so low it was unheard of, and many people in real estate were saying, get them while you can because you will never see these rates again. Now, if you follow real estate, you'll hear a lot about rising interest rates and how that affects the market. So how did that happen, and more importantly, why? Hey, my name is PK. I'm a mortgage agent here in Canada, and this is my first video on this YouTube channel, the first of many, about real estate, mortgages, and finance in general. I've been doing some short form content for some time now, but I wanted to do some long form stuff as well. One, I think I'm better at it and I like it more. And two, when you're explaining some more in-depth concepts, it takes more than a 30-second vertical video. This video is about interest rates, more specifically mortgage interest rates, why they've gone up in the past 2 years, and how exactly that whole system works. So let's start at the top, literally, the top of the crazy real estate market of 2021. Real estate was on fire, and so was everything else. You could have been the worst investor in the world and still have made money. All you needed to do was buy something, anything, because everything was shooting up in price. Real estate, stocks, luxury watches, new cars, used cars, NFTs, useless cryptocurrencies. Now, I'd like to do a separate video on the bull run of 2020 and 2021. It's kind of my first speculative bubble that I got to experience firsthand. But what I'm trying to get at here is why. Why did home prices and the markets go crazy? And the major contributing factor to this would be interest rates. More specifically, low interest rates, otherwise known as free money. Now, when I say interest rates, I mean generally across the board. There are tons of interest rates, car loan rates, credit card rates, mortgage rates, the prime rate, the policy rate, and you'll learn about some of those in this video. But the overall level of these rates in the economy actually have an effect on the economy. When rates are really high, people don't want to borrow, they buy less, and they also save more because the interest rate they get on their savings is also higher. When interest rates are really low, it's cheap to borrow money, so people buy more and save less, which makes the economy shoot up. And it's exactly for that reason in 2020, when the pandemic broke out, we went through a recession or an economic slowdown, call it what you want. Interest rates were lowered to help stimulate the economy, and they went really low, basically rock bottom, and they were already low since the 2008 financial crisis. Whenever you have an economy with really low interest rates, it tends to be followed by these speculative bubbles or bull runs, which is how I would say we got to the crazy markets of 2021. Warren Buffett likes to compare interest rates as gravity to stock prices. Real estate prices would work here as well, and we essentially got put into a zero gravity environment. My basic thought around it is that when interest rates are really low, people don't want to get a 1% return on their traditional safe investments, so that money goes elsewhere looking for better returns. A really good book on this is The Price of Time by Edward Chancellor. It's basically a history about interest rates, and it explains how having really low interest rates leads to these speculative bubbles, inflation, etc. I'm only halfway through it right now, but it's a really good book. If you like this kind of thing, it's a recommendation from me. So now you know why interest rates were lowered. Why have they gone up recently? Low interest rates were great and all until this thing called inflation showed up, and that started going up. Lower interest rates does stimulate the economy, but they also didn't just lower interest rates, they also increased the money supply. This is called quantitative easing. And when you have a lot more money chasing the same goods and services in an economy, those goods and services go up in price. With low rates, people are buying things like homes and stocks, and those asset prices are going up because of that. And then people take a look at their stock portfolio and they feel wealthier. There's these wealth effects attached to this. You get a call from the Rolex dealer and they're like, we got a Daytona, solid gold, green dial. And then you look at your stock portfolio and you're like, my net worth went up 25% this year, let's splurge on it. And then couple that with the lockdowns and supply chain issues, things were not being made, things were not being delivered. So you have low supply, high demand, things are going up in prices, not just luxury goods and assets, but things like food, energy, gasoline, and these things are going up in price faster than people's incomes are going up, and that is inflation. High inflation is not a good thing, especially if it sticks around for a long time. So how are we gonna get out of this? We got ourselves here by printing a whole bunch of money and lowering interest rates, and we're going to get ourselves out by doing the opposite. This is where I will introduce the Bank of Canada. Now, they're not a traditional bank where you deposit money with them. They're a crown corporation whose job is to keep inflation low and stable, which it currently is not. And one of the ways they do this is by changing or manipulating the interest rates in the economy. For example, I just explained that in 2020, they lowered interest rates. But when I say they lowered interest rates, they didn't go to every individual credit card and mortgage and lower the rates. So how does the Bank of Canada change interest rates, and why do a couple of people making a decision in a building change what you pay on your mortgage? Like I said, the Bank of Canada does not have direct control over every single interest rate in the economy. What they do have control of is the policy rate, otherwise known as the overnight rate or the overnight target rate. Here's something you should know. Banks borrow money from each other all the time. Over the course of the day, they'll be sending out and receiving payments. At the end of the day, some banks or financial institutions may have sent out more money than they took in, and some banks and financial institutions may have taken in more money than they sent out. So to balance their accounts at the end of the day, the ones with deficits will actually borrow money from those who have the extra funds on hand. One bank gets to cover its transactions for the day, and the other bank gets to make some income by loaning out that money at interest. The interest rate at which this money is lent from bank to bank in the overnight market is decided by the policy rate, which is what the Bank of Canada can change. And banks are in the business of getting money at a certain interest rate that they pay, and they lend that money out at a higher interest rate. For example, they'll take the money in your savings account and give you less than 1%, and take that money and lend it out to somebody at 5% for a mortgage. I know, crazy. So if we want to increase the level of interest rates in our economy, and the reason why we want to do that is because we want to slow the economy down to help fight inflation, we would increase the policy rate, because that makes it more expensive for banks to borrow money every single day, and it's also more expensive now to run their business. And just like how if it takes $10,000 for parts and metal to make a car, the car company is going to charge you more than that. When the money that the bank gets becomes more expensive, the interest rates on their products go up. Not just mortgages, but credit cards, auto loans, a whole bunch of things. And this can be seen in the prime rate. Now, the prime rate is an interest rate that each bank sets on their own, and they use it to price all the other interest rates on their loans. So if you increase the policy rate, if it's more expensive for banks to borrow money in the overnight market to run their operations, the prime rate goes up. And it's important to understand the policy rate and the prime rate are not the same thing. Now, you would think since each bank sets their own prime rate, they all have different prime rates, but because they have to compete with each other, or maybe they coordinate it, they actually all have the same prime rate usually, at least for the big banks. Also, a side note, mortgage companies or monolines, that is companies that just deal with mortgages, they also have a prime rate which is usually the same as well. So how does the prime rate affect mortgage rates? Well, the prime rate specifically affects variable rate mortgages, and that's because a variable rate mortgage is directly tied to the prime rate. The way a variable rate works is you have your prime rate and then you have your variance. And that is just a fancy word for what you're adding or subtracting to get the interest rate on your mortgage. For example, your variable rate could be the prime rate minus 1%. So if the prime rate was 2.45%, your interest rate would be 1.45. And if the prime rate went to 6.7%, your interest rate would then be 5.7%. This is the policy rate over the past year. You can see that the Bank of Canada has raised it quite some bit. And yes, at one point in time, banks were borrowing money overnight at 0.25% interest. And no, unfortunately, we the public do not have access to these rates. And this is the prime rate over the exact same amount of time. And as you know now, this would cause variable rate mortgages to go up. But how does this affect fixed rate mortgages? Now, fixed mortgage rates are actually based on government bonds. Now, when you buy a government bond, you basically make a loan to the government and you get a specific interest rate. The interest rates you get on these bonds loosely follows the policy rate, but there are a whole bunch of other factors affecting it. But what you need to know is that fixed mortgage rates are specifically based on the rate that we get on bonds. The thing about government bonds is that they're a very safe investment. You're loaning money to the government and they can print you the money to pay you back. And mortgages are riskier than loaning money to the government. They're also more expensive to set up because you have to hire your employees that get and underwrite mortgages. So from the bank's perspective, if I can loan money out to the government at 1%, why would I loan money out on a mortgage at 1%? It's riskier and more expensive. And so they don't do that. Usually they charge 2 to 3% more than what the government bond is giving. So if the 5-year Government of Canada bond is giving you 1%, 5-year fixed mortgage rates would be around 3 to 4%. And when bond rates go up, so do fixed mortgage rates. So 2020 happened, and to save the economy, we lowered interest rates, which was great until inflation started to spike. And that's not good. So now, in an attempt to fight inflation and bring it back down, we have increased the interest rates. And because of this, mortgage rates went from historical lows to where they are now. Also, don't take this as advice when you're specifically choosing a mortgage, especially depending on the time you're seeing this video. This is a very macroeconomic view about how the mortgage market works. When it comes to actually getting a mortgage, it's a very individual process, and you have to tailor the mortgage to your specific needs. It very much depends on the time and place and your current situation. Take this video as an overview of interest rates, specifically mortgage rates in the Canadian economy. Now, if you want recent news and mortgage tips, you can follow me on the social medias. I do content on the most recent things there, and I will now be doing them on here. I would tell you to go watch another video, but I do not have any. So leave your suggestions and questions in the comments and stay tuned for the next one. Thank you for watching.